Good morning, Jags. This is Fahad. Today is Wednesday, July 29th. Let's get started. I want to just shed some light on Spotify earnings that came out this morning. Naturally, because this is a big position for us, and the stock is gapping down by about 3.5%, 4% in pre-market. So it's worthy of discussion to see exactly what I'm seeing. The stock closed at $267 per share yesterday, and it's going to be gapping down to $256, so about $10 to the downside. From a technical standpoint, understand that this level around here, 245 to 250, is an important support level where it has bounced off multiple times after this huge volume breakout. And if you draw trend supports, going back all the way from when the podcast business starts to actually take off, that in a case when the sell-off continues, could potentially take it all the way down to about 230 to 235. But I don't know if we're going to push that low, but naturally these are the support levels that you need to be aware of. Now, with that said, it turns out that in this particular quarter, the second quarter that was posted tonight, the biggest takeaway is that while the total premium services, the total premium the total premium subscribers continue to grow. In fact, year-over-year growth was still very, very strong. If you look at the first read right over here, you can see that the monthly active users were a beat, coming at 220 or 299 million. And if you look at some of the slides that the company has presented, for example, right over here, directly from the presentation, you can see that the total monthly active users was up 29% year over year and 5% sequentially compared to the first quarter. Similarly, the premium subscribers were also up 27% year over year and 6% sequentially, and the ad supported were also up. The issue, however, was, and the company highlighted this in one of their discussions, is that they did see slightly higher uptick in the churn rate in the second quarter, in the early part of the second quarter when the shutdowns were in effect, particularly in Latin America. So in Brazil, and in other countries in Latin America and some parts of Asia, they did see some cancellations slightly rising above the normal. But then by the time June came around, they started to see reactivations actually take off. So a lot of the same subscribers that quit the service, maybe because of job losses, maybe because of other conditions, they actually started to come back. And as a result, they ended up finishing the quarter only slightly below their internal plans, still on a year-over-year basis, and with sequential growth that is highlighted in this chart over here. You can see that this was still positive and rather very, very strong. Going forward, though, they are not really changing their guidance for the third quarter or as well as the fourth quarter. In fact, as we discussed in the first read, both of them are quite in line with expectations. Important thing is that in each of the next two quarters, they're expecting revenue growth to remain in the mid-teens percentage before gradually accelerating back to above 20% year over year. And each of these quarters is going to be about 2 billion euros on a US dollar term. So I think it comes out to about 2.7, 2.5 to 2.7 billion US dollar run rate. And so when you multiply that, considering considering the conservatism that's built into this, on top of it, consider the year-over-year growth rate and the sequential improvement, you get to an annualized run rate in US dollar for revenues of about $10 billion sometime this year. And then for 2021, then you apply the mid-teens, similar kind of a growth pattern, potential acceleration, because podcast business is going to start to take off with Joe Rogan coming online sometime in September, and then many other podcasts also coming online. You're looking at a revenue run rate of about 12 to 13 billion dollars for 2021. Then you apply valuation of $48 billion in pre-market market capitalization on top of it, and the stock is trading at about 5 times, 4 to 5 times, more like 4.5 times its sales, which makes a very compelling case that this remains a rather very cheap and yet high growth stocks. So that's the one thing that stood out for me, that it remains very, very strong in terms of both valuation and consistency in the top line growth rate. You can see this comment right over here. This second paragraph over here is the most important one. Early in the quarter, we observed some COVID-related softness in several countries across our emerging markets. Parts of Latin America and rest of the world saw slower than expected growth in April and May, as we saw lower intake and increase in churn and increases in payment failures from the premium users. Encouragingly, these things rebounded significantly in June as we saw increased reactivations and a step down in churn. While we finished below the forecast in aggregate across these regions, our strength in North America and other areas more than offset the slow start to the quarter. Additionally, we believe the improved momentum we saw in the back half of the quarter has continued into Q3, and we expect to hit our full year targets. So this shouldn't surprise anybody. This is very common theme that has emerged, even some of the strongest companies that are out there. And quite frankly, what company do we know out there? How many can you identify that can still grow both year over year and on a sequential basis at a time when the economic data was absolutely hideous in early part of the second quarter? So I wouldn't read too much into this quarter aside from what I just mentioned. I think this was a passing quarter, and they were still able to hit or just slightly below their internal targets as well as street targets. But I think from this point on, we could see material acceleration as podcast business takes off. These are the guidance that they provided for the third quarter as well as the fourth quarter in the press release. And so that's something to keep in mind. And the last thing I will mention is that there's a lot of other qualitative factors in this earnings report that you need to take a look at to sort of understand whether the platform is improving and the engagement should continue to go up, and whether the overall content, the type of content and everything that the company has continues to go up. So the second paragraph here talks about it. Remember, they signed a whole bunch of new partnerships all in July. So they never benefited actually what was happening in the second quarter. They're all going to benefit the third quarter. That's why I believe that, and the third quarter is also the quarter when Joe Rogan and other major podcasts will begin. So that's why I believe there's a lot of conservatism as well, even though the third quarter guidance was mostly in line. And the company mentioned that the number of artists on the platform has grown on a monthly basis by more than 690,000, is 68% growth year over year. And these creators are finding ways to unlock new channels for discovery, which means the content just continues to go up. Growth in the number of artists make up their top tier, those accounting for more than 10% of the streaming, is accelerating. That cohort now stands at over 43,000 artists, up 43% year over year. And similarly, they talked about whole bunch of other things. Gone are the days of the top 40. It's now top 43,000. Marketplace continues to grow rapidly, and they continue to actually add more and more content and continue to enhance the quality of the content for streamers. And then lastly, they also talked about that the conversations that are happening on the platform between these artists and the streamers, those conversations also continue to improve, which means the engagement on the platform continues to improve, and that was up sequentially by more than 37% quarter over quarter. So overall, this was a very high quality quarter. I understand that people are going to try to poo-poo all over this because they're going to see, okay, the headline was a bit of a miss on the revenue side, and they're going to talk about a slightly higher uptick, but you need to drill down, slightly higher uptick in the churn rate, but you need to drill down into the more nitty-gritty details to really understand how this company is actually performing at so many levels, and I continue to like this company a lot. So I just wanted to mention based on my reading of all of this. Now, with that said, Chronicle.
Morning, everybody. So over the next week, I'm keeping a very close eye on 3 different apartment REITs. As many of us know, the federal moratorium on evictions expired last Friday, and if anyone's not familiar with the term, what an eviction moratorium is, it's basically a rule that prevents landlords from kicking tenants out of their properties if they miss rent. And as of this week, evictions have begun across the country. It's all over news sites, local news sites, and Twitter. But if we go to the next slide, although the federal moratorium has expired, we can see that there are still lots of local jurisdictions that have implemented their own extensions. For example, I know that New York has indefinitely extended its moratorium to last through at least the end of the pandemic, so potentially deep into next year. Meanwhile, LA County has extended its moratorium to September 30th. And I know Dallas and Tampa have extended theirs by a month, while Seattle and San Francisco's extensions apply through the end of the year. So these regions are all moving to protect their tenants. And the reason I'm mentioning all this is because with the $600 per week additional stimulus checks having expired, and looking at what is likely to be a protracted affair between the Democrats and Republicans regarding the upcoming fiscal stimulus bill, this is likely going to be the first week where people are going to stop receiving their checks. And if we combine this with the fact that landlords in New York, Seattle, Tampa, LA County, Dallas, they're not going to be allowed to evict, then we could potentially be looking at scenarios where tenants can't make rent without their checks, and these landlords won't be able to do anything about it. On the next slide, in terms of where we are right now, Apartment List was out with some checks last week, and they found that missed rent payments hit a new high, a new post-COVID high this month at 32%. And so if people are already missing 32% of their rent payments with the $600 per week additional stimulus, then just imagine what happens if they miss out on even just one weekly check. And on a side note, I think if Congress ends up passing a bill that reduces payments to $200 a week or caps payments at 70% of wage, I think that's asking for trouble. Because when I look at the latest job openings and job cut statistics on the next slide, the numbers are still very weak. So this idea that if we just reduce the stimulus and that will get people to magically go out and find work, that's not feasible, at least for now. Maybe later it is. So if businesses are still cutting back on staffing and creating very few openings, this could create a problem. So this proposal of $200 a week or 70% of wage, or even a hypothetical $400 per week compromise between the two parties, for that matter, that's not feasible right now. I mean, sure, there are going to be a couple of determined types out there who find a way no matter what, but the majority are not going to be able to make do, just from looking at all the ground level commentary up and coming across, both in red and blue states. And personally, I don't think this current proposal is going to pass. And what's likely to happen instead is that negotiations are going to drag. That said, I do think the eventual bill is going to be a bullish one because the Democrats are asking for $3 trillion. So they're probably going to meet somewhere halfway between 3 and 1 trillion, but I think it's going to take time to get there. On the next slide, what this means is August rent collections for a lot of residential REITs is likely to reflect difficulties because remember how I said tenants in Seattle and San Francisco are safe from eviction until the end of the year, and LA County is protecting tenants until September, while New York is protecting them indefinitely until the end of the pandemic. And also keep in mind, these three places have some of the highest rents nationwide. So these landlords could hypothetically be losing out on a huge chunk of payments and cash flow. On the next slide, I've singled out 3 different residential REITs to watch for potential further downside. The first REIT is Equity Residential, symbol EQR. This company has 14% exposure to New York, 11% to Seattle, and 21% to San Francisco. So at least 46% of its rent revenue is exposed to these eviction protections. Second REIT is Avalon Bay, symbol AVB. They have 19% exposure to greater New York City, 6% to Seattle, and another 20% exposure to LA County. So 45% of their rent revenue exposed. And on the final slide is Essex Property Trust, symbol ESS. For this company, 100% of its portfolio is situated in LA County. Next slide. San Francisco and Seattle. So if this fiscal bill gets delayed, or if the Republican proposal materializes with either $200 per week or the 70% of wage cap. If any of these scenarios happen, I think this particular company is in trouble. And for all three companies, I would also add that the ongoing migration from large metros to more rural areas is also another headwind. So those are the three I'm watching closely. Situation today is still too binary to be betting against the government, but if we get to Friday or early next week and people start not receiving their checks, while at the same time we continue to get headlines about Republicans and Democrats still being far apart, I think that's when we start to see some panic set in. And as a result, I think there could be some nimble short selling opportunities where we quickly get in and play the panic and quickly cover and take profits before Congress starts moving quicker. And maybe put some measures in place to start protecting these landlords, like mortgage relief or something along those lines. We're still in a bull market, so I'm looking to be nimble and more catalyst driven with shorts. What I will say is that all three short charts here, they look like they haven't participated in the rally in the last couple months. There have been some short pops along the way, but they haven't participated.
You know, on one of the slides, by the way, here is Essex Property Trust. Here's the Avalon Bay Communities, and here is EQR. All three of them look exactly pretty much the same. Steady downtrend, although they bounced sharply yesterday, but just so much similarity between all of them, and they're all sitting near March lows, interestingly. So absolutely no participation in the equity markets coming off the March lows, and particularly for the last 2 months, they have been just steadily down, down, down. I want to point out, going back to this one slide, because right over here, I was watching the news last night myself, and I continue to ask myself this question, that whether it's $1 trillion package or not, there, even if they find some sort of terms of agreement between the two biggest, the Republicans, Democrats, there is still so much other problems in the rest of the parts of the economy that needs to be addressed by fiscal packages, that where there's simply not going to be sufficient amount of money to address those things, because we're talking more, the evictions and moratoriums, and we're talking the payments for the federal unemployment insurance, and that itself adds up to a very large number. But what about all the states and cities and your local jurisdictions that need money because their tax shortfall across the entire country? And then similarly, there have so many other parts that are that have gone into a distressed position at this time, that this, even if this bill passes some kind, the overall it's still not sufficient, $1 trillion such. And secondly, this will be the last bill. You can look at how much dispute they're having just to pass this one out. The reason simply being because they can't provide everything to everybody, and this will be the last one that will be passed before elections. And so there is a point where, with continuous shutdown, uneven shutdowns that have led to more than 70% in the country in some parts or some form of lockdown right now, particularly in the South, where the chances that we basically see the unemployment rate on top of this picture stabilize around 10% instead of consistently coming down, while you have all of these cuts in the federal unemployment rate and you have this eviction moratorium. And then you add the weak equity market seasonality that also begins sometime in September and October. So there are a lot of parts to consider about this entire thing and how it may actually affect the investor psyche going forward from here. All right. Did you pick up all of these headlines for various newspapers? I was just looking at some of these dates. Yeah. It seems like it picked up from so many local journals. Good stuff, guys. Thank you. And then Jay.
Hey, Vod. So 2 names really quickly. Number 1 is Starbucks. Yep. As we all can see, shares are higher pre-market after yesterday's earnings report. Most analysts are also not upgrading, but they're raising their price targets. Looks like Wells is going to 93, Barclays is going to 94. Just a little bit of color from their earnings call. In the United States, for those stores, the company highlighted family orders due to parents working from home. So this increased the order size. Now, this is most likely going to kind of fall off over the next couple weeks, possibly months. So not something to really kind of bet on going forward. They also talked about their announcement of digital handhelds, curbside pickup. Handhelds are going to be used to expedite long drive-through lines, and then curbside pickup is going to be rolled out to 700 to 1,000 locations by the end of this quarter. Now moving to China and their stores, company launched an update to their Starbucks rewards program back in May. This resulted in a 25% sequential increase in loyalty members over the quarter to 9.9 million active users. And then finally, through its digital partnership with Alibaba, it's going to be rolling out its mobile order and pay feature to multiple platforms. Stifel says this will significantly extend the availability of the mobile order and pay service to a combined base of nearly 1 billion current users.
Regarding China, they added, I believe, 100 new stores in the second quarter. I saw this in the press release last night, and I thought that was very impressive at a time when everything was shut down. They actually added 100 new stores, opened 100 new stores in China. So, and then also, I think that this was my big message when we recommended buying call options going into earnings in this stock, where I was simply watching how this company is being forced due to COVID, is being forced to turn more and more digital in nature, basically become a tech company. So now we're talking monthly active users in Starbucks. I mean, we'd never used to talk about things like that or metrics like that. That's because their loyalty program is taking off. That's because they're going to start to monetize a lot of the members on the loyalty program, both internationally and domestic. So I thought this was all positive elements. And just looking at it from a pure same store sales basis, because that's naturally going to be disrupted from COVID, I think there's so many other parts or ways of now evaluating Starbucks than how we have evaluated it in the past. So I think the company is making changes for the right reasons, and they should be noteworthy, and stock is deservedly higher for that reason. Next one.
So the next one is definitely a speculative name. Each night when I'm looking at these transcripts, sometimes I come across a name that I'm not familiar with. So that intrigues me. I find out what the company does, and then from there I see if I want to look at the transcript. So the company, and I'm actually going to post a homepage article on this later today. The company is called PRGX Global. The ticker is PRGX. And it's a $5 stock, but this is a recovery audit service company. Essentially what they do, they help their customers basically look at their financial statements and see if they are overpaying in some way to their third-party suppliers. As they say, they help identify value leakage with their proprietary platform. But anyway, some items from their transcript caught my attention, so I thought it would make a good homepage article. And if I look at the technicals, now I'm looking at stock charts, and I have I think a 5-month chart. It is at the upper end of the channel right now, but it has made a move since the beginning of April. And like I said, there is some content within the transcript that I thought could be of value.
Yeah, interesting pick. I don't know anything about it, so you've caught me off guard because so I'm now very interested exactly what you're going to be coming up with in your discussion in the article that will be posted on Jaguar homepage shortly. But in terms of technicals over here, this was a very high volume push. So I'm interested in finding out what happened here when we had that massive high volume push and a breakout through the VOP congestions level. You can see all of this VOP congestions around 4. And the stock held that level on multiple times when it pulled back, and then recently started to break out again, once again on rising volume and with a power candle. So chart is very, very good. And it clearly shows these kind of volume profiles and breakouts clearly shows that it's under accumulation. So purely from a technical standpoint, this looks good for even more upside from here. But from the fundamental standpoint, I'll wait until you tell me in your article what's in it and what caught your attention. Good stuff. Avo.
Morning, everyone. Looking at Dropbox today. Yesterday there was call buying in August strikes, which are positioning likely for earnings. So the 22, 23, and 25 strikes saw activity, namely the 25, but that's also the cheapest one. All reflected in open interest this morning. Note by, yeah, you can see it there.
In the August?
Yeah, August, the month.
Okay.
So that is the one
you know,
part of it.
do you have any channel checks you have pulled on this one yet?
Yeah, there's
it'll
a
be
note
worth-
by RBC that came out a couple of days ago talking about the app downloads and website traffic data that they've seen some modest acceleration of downloads and traffic, especially around May. Now, let me just scroll down here. So total website visits were up 7% quarter over quarter, although they were down 3% year over year. And the app downloads increased 16.9% year over year and 8% quarter over quarter, which is the strongest growth on record according to RBC.
So still bad year over year, but sequentially it has improved based on these channel checks. I will add one color to Dropbox. I have this sort of like hate and love relationship with Dropbox ever since the company did the IPO. My concern has always been that the business model itself is going to continue to be competitively disadvantaged because the hyperscalers, the Google, the Amazon, and the Microsoft, the world's, they have really lowered their pricing for cloud storage. And as a result, they can, on top of it, they can provide services, ancillary services related to cloud that Dropbox cannot match. And so competitive landscape is materially stacked up against Dropbox. And that's why in your channel checks too, when you're looking at year-over-year growth rate, at the time of this IPO, a couple of years ago when it came out, people used to talk about this thing is going to grow at a perpetuity, it's going to grow 20%, 30% year over year at a perpetual rate, for many, many years to come. And that naturally did not work out. And you can see the trend has actually turned negative on a year over year basis. But is oversold enough? Is there a play to be made now, given that I would assume that this too is a beneficiary of the work from home crowd as the cloud services needs have gone up? So that would be my thing for potential trade only, not as an investment. Maybe there's a play to be made going into earnings. I'm interested in looking at what else in that channel checks, if you have more details on that one.
Well, just to correct one thing here, the year over year actually increased in app downloads, but yeah, it did increase in website visit. Now, the one interesting thing that I find here, and I'm just trying to get, I don't know how you would quantify something like this to find out if it's correct or not. So RBC says, looking to paid user ads, our analysis points to a net increase of 375,000 to 450,000, which is above guidance consensus at 100 to 200,000. So this will be a huge difference, and ahead of their recent quarterly averages around 300,000. So I don't know if this is a typo or what, but
no, if it is good, it probably is good because there has been a material shift, in companies that were dead previously, but then suddenly found themselves growing blockbusters, during the work from home shift. And so this could be one of them, at least for a trade. Interesting pick there, rather contrarian that not many people talk about. And with the increase in call buying, it might be worthy of attention more than it deserves just for a trade.
And it's not an expensive stock to get into options wise. But the only thing is that, of course, we have all these Apple and Amazon reports coming up tomorrow, rather. So the Dropbox reports next week might be worth waiting a little bit to see what transpires between now and then. But that's it.
Yeah.
I didn't find any other notes, unfortunately. There's not a lot of coverage for Dropbox, but this is what I see.
Yeah, that's because probably many people have just given up. 3 years of downtrend starts to wear people off. Anyways, thank you very much for joining, and good stuff. We'll see you in the chat room shortly.